The puzzle of Japan and South Korea's second transformation. Although many countries and regions became World Bank high-income economy after World War II, only 2 countries are recognized as successful transition manufacturing powers and developed economies: Japan and South Korea. As a latecomer country, China has also been learning from the experiences of Japan and South Korea. However, since the real estate bubble burst in the 1990s, Japan's economy has stagnated, and the proportion of industrial added value in the world has fallen sharply. Although South Korea has not experienced a significant decline, it has not risen in the past 20 years. The decline in the global share of industrial added value in Japan and South Korea is actually difficult to avoid, as the rise in labor wages is rigid, which is also the cost of becoming a developed economy. In recent years, the salary cost of China's manufacturing industry has been significantly increasing, while Japan, although there has been a significant decline, is still high. Thailand and Vietnam are still relatively affordable. This can explain why Japan's manufacturing industry will shrink and China's low-end manufacturing industry will relocate. In 2021, the per capita wage in China's manufacturing industry has increased to $14,295 per year, which is close to 50% of Japan's. Taking Thailand as an example, in Southeast Asian countries, the per capita wage in the manufacturing industry in 2000 was $1,789 per year, even slightly higher than that of China at the time. However, by 2021, it had only increased by 2.8 times $5,089 per year, which was nearly 2/3 lower than China. In recent years, China's emphasis on energy conservation and environmental protection has also increased the production costs of manufacturing enterprises. From the perspective of net inflows of overseas direct investment (FDI), both Japan and South Korea have net outflows. With the promotion of the Belt and Road, China's capital output has increased, and there may also be net outflows in the future, because FDI usually flows from developed economies to developing economies. This is in line with the logic of development. Developing countries have cheap labor costs, large development space, and corresponding high investment returns. However, a net outflow of investment does not necessarily mean that the economy will experience a recession, as strong economic countries such as the United States and Germany are also countries with net outflows of investment. So why did Japan experience a long-term economic recession? From the perspective of credit investment in Japan, investment in manufacturing continues to decline, while real estate still maintains an upward trend. This indicates the hollowing out of the manufacturing industry in Japan, with the proportion of manufacturing loan balances decreasing from 35% in 1977 to 11% in 2021. The proportion of real estate loans increased from 12.8% 16.4% after the real estate bubble burst in 1993 to 16.7% in 2021. Looking back at South Korea, there is a similar situation, where the proportion of credit balance in the manufacturing industry has decreased and the real estate sector continues to rise. In this regard, we can easily draw a preliminary conclusion: the excessive dependence on real estate will eventually lead to the bursting of the economic foam, which will lead to a long-term recession of the economy. Since the end of 2022, housing prices in South Korea and Seoul have shown a significant downward trend. In the past 10 years, the average housing price in Seoul has increased by about twice. Because the full rental promotion model will play a role in fueling or helping the decline. That is, accelerating the rise when rising and accelerating the decline when falling. The consequence is that the real estate bubble bursts, making the economy worse. The housing prices in Tokyo, Japan reached a historic high last year after a 30-year hiatus, which is the result of Japan's insistence on not raising interest rates and a significant depreciation of the yen. But Japan's CPI in March was 3.2%. And once the Bank of Japan withdraws from loose monetary policy, its housing prices may fall. So, once the economy overly relies on real estate, its financial risks will be closely linked to housing prices. Japan and South Korea are both countries with small land areas and high population density, and their domestic consumer market capacity is limited. Against the backdrop of declining competitiveness in its manufacturing industry, it is natural to consider real estate as the main means of driving the economy. However, in the context of a decrease in the total population and an accelerated aging population, the high housing prices will increase the economic burden on young people and further reduce their willingness to have children. For example, South Korea entered a deep aging society in 2018 with over 14% of the population aged 65 and above, and will enter a super-aging society in 2026. Such rapid aging will inevitably lead to the ultimate downturn in the real estate market. Although Japan and South Korea are still global manufacturing powers, their importance in the global industrial chain is significantly decreasing, which is also worth reflecting on.